Hi students, there were many requests to me regarding the question bank 2024-2025, how it is going to impact and any changes in the question bank. I will come to the changes later, but today I will tell you whether solving the question bank 2024-25 is relevant or not. So first you need to understand when this question bank 2024-2025 is issued during this academic year, that means that certainly it is going to impact your preparation, because so many days you have prepared for from a question bank which was designed during the academic year 2018 and 19, and now you need to change. Because why I'm saying change, because if you look at the requirement of the examination, recently you might have read a news regarding the difficult portion. Earlier it was 90% easy and 10% tough, or difficult instead of saying tough. It was 90% and 10%, but now it has been changed to 60 and 40, which means your exams are not going to be that easy what you were seeing previously. So today, let's see, are there any changes in the question bank regarding, especially initial chapter I will be discussing, initial chapters I will be discussing. As I have seen, there is no much change, very few changes in the theoretical part, and there are few problems which have been added, and only few problems are there which have been deleted, right? Addition is more and deletion is less. So today we will be looking at theoretical aspect of initial chapters. Okay, so let's begin. But what I like to remind you is, don't take this exam lightly. Number one, this 60-40 portion, 60-40 ratio, because 60 easy, 40 difficult, that means you may expect some questions which are even not there in the question bank. And you remember, board has already given a declaration that it is not necessary to ask the question only from the question bank. The paper setter has the liberty to ask question from anywhere but within the syllabus. Okay, so now next is coming to the first chapter, that is fundamentals of partnership. Let's see, this is the question bank committee. Kumbar sir from Bijapur, Sanjeev sir, they have done excellent work, because the question bank has not been revised since long time, right? And this time it has been revised and it has come out very well. Tunga sir, who has always been active, what we need to appreciate is they have taken initiative to redraft it, because it was very old. There were some errors in the question bank. Even this question bank may also contain some errors, but the good thing is it has been changed, because even though the pattern was changed, the question bank remained the same. But this time we have the question bank which is in line with our question paper, right? So starting with accounting for partnership, that is basic concepts. First one, multiple choice question in the multiple choice segment. First, agreement between the partners may be in, it can be oral or written. Remember, always remember, it can be oral or written. But preferred, when they ask which one is preferred, then it is written. Oh, sorry, I marked it wrongly. It is oral or written. Okay, then preferred is written, but it can be either oral or written. There is no restriction in the Partnership Act that it should be only written. Okay. partnership deed may not contain, see, it contains nature of the firm, it contains name and address, it contains the PSR. Okay, sometime what happens, PSR may not be there, but we assume, but normally it is one of the contents of the partnership deed. But they don't mention anything regarding the ownership of property. If any partner has advanced some money to the firm beyond the amount, that means we call advances. So question is, he shall be entitled to interest on the amount at the rate of, we all know that it is 6% per annum. Next is, this one it was, yes, next, the answer here was ownership of property. The next is, interest on capital is generally provided for when, see, why interest on capital? Remember, see, if everyone is contributing same amount of capital and if everyone has the same profit sharing ratio and all are active partners, then there is no question of this salary interest on capital will arise. Okay, it arises when they are not same. For example, first one, the partners contribute unequal amount of capital. Capitals are different, but the profit sharing ratio is same. That means equal. The partners contribute equal amount of capital, but the share of profit sharing ratio is different. In that case, that means in both these cases, we need to provide interest on capital. Next, when fixed amount is withdrawn on the first day of every month, interest on total amount of the, remember what they are saying, first day of the month. If you remember in my classes I said, it will be, there are three things. One is month, next is quarter, and then next is half year. See, half year is not applicable to you. Now let's only discuss about month and quarter. Then in that there will be beginning, there will be mid, and there will be end. In case, and always remember, whenever there is mid, it will be 6. Whenever there is mid, it will be 6. And if it is beginning, in case of month, add 0.5, and in case of end, you deduct 0.5. Whereas when it comes to quarter, it will be plus 1.5, that is 7.5, and here it is minus 1.5. So what he has asked is, first day of every month, then it should be 6.5. Next, when varying amounts are withdrawn at different intervals, the interest is calculated by using, remember, varying amounts means product method. See, remember, 1 or 2 drawings, then we go for direct method, right? More than 2 and this condition, that is varying amounts are there, then varying amount and the dates, then it will be product method. When the amounts and dates are uniform, then it will be average method, and there is no such method called as weighted method. The answer is product method. Adjustment for correction of omission and commission can be made in, see, it can be done in both A and B. That means you can either do it in P&L adjustment account or you can directly do it in the capital account. Next is, in order to form a partnership, there should be at least, everyone knows this, 2 persons should be there, and maximum is 50. Next, the business of partnership concern may be carried on by all the partners or any of them acting for all. Even this is what the section 4 definition says. Relation between persons who have agreed to share the profits of the business, then carried on by all or any of them acting for all. Then the agreement between partners must be to share profits and losses, but there can be a partner only for profits. The liability of a partner for acts of the firm is unlimited, right? This is one of the disadvantages of partnership business. The partnership deed should be properly drafted as per stamp there was like always वहाँ एक like dual mindset था teachers का कि few were saying partnership act, few were saying stamp, but ultimately as per the NCRT it is stamp act. The next is 13. The clauses of the partnership deed can be altered with the consent of all the partners. Consent is needed to change the partnership deed. In the absence of partnership deed, profits, ये very simple question है, equal, and that's why if you remember in the admission of partner in the initial problems, in few of the problems they have not mentioned anything about the PSR. In that cases we have divided the profits equally. When the dates of the withdrawal are not specified, interest on drawings is to be calculated on the average period of. See, if it is not mentioned at all, then remember it should be 6 months. That means we assume that the amounts are being evenly withdrawn during the year. Right? On the same principle, this time, like few questions have been added in the profit and loss appropriation account in the new question bank. There are 1 or 2 questions which test on this aspect. They have mentioned about the amount of drawings, they have mentioned about the rate of interest, but they have not mentioned when the drawings are made. In that case, we have to multiply the amount of drawings into rate divided by 100 into 6 divided by 12. Now let's come to fill in the blanks. Remember, in the exam they will be giving you hints, but here there are no hints for you. First, section 4 of the Indian Partnership Act defines partnership, I said, as a relationship between persons who have agreed to share the profits of the business carried on by all or any of them acting for all. A partnership has no separate legal entity like companies. In company the ownership and the management both are, or you can say the company and owners are treated as different, right? Company can own property in its name, can borrow money, but this is not possible here. In order to form a partnership, there should be at least, very simple, 2 persons. Partnership is the result of agreement, very simple. It is preferred that the partners have an agreement in writing. I said the same thing I was saying while we discussed MCQs. The agreement between partners should be to carry on some legal business or trade or business, right? Each partner carrying on the business is the principal as well as agent. We call it as agency relationship, okay? The liability of a partner for his access, we have already seen, it is unlimited. In the absence of partnership deed, interest on advance from the, we have learned this, that is 6% per annum, okay? Under dash method, the capital shall remain fixed under fixed capital method. Under fluctuating capital method, partners' capital account balances change, vary or fluctuate from time to time. Profit and loss appropriation account is merely an extension of P&L account. This is what the meaning of P&L appropriation says. It says that profit and loss appropriation account is an extension of profit and loss account prepared to show how the profit is distributed among the partner, or it shows how the profit is distributed among the partners. Then 13, profit and loss appropriation account debit. 2, it is interest on capital because it is for the transfer. Then profit and loss appropriation account to salary account. When salary to partners, when the partner's salary is transferred. P&L appropriation account debit to partner's current account being profit transferred. Okay, being profit transferred. See this, they have given, we no need to connect it because Partnership Act, Partnership Act, so it is not directly given, sorry. Partnership Act 1932, consent of all partners we have seen above, that is Consent of partners is required for the alteration of partnership deed. Interest on drawings in the absence of deed is not to be charged. Next, each partner has only one account. It is under fluctuating, because under fixed they have two, that is current and capital, but in under fluctuating we only have one capital account. Assurance of minimum profit, that is guarantee of minimum profit. So this 6% is odd man out here. Then next comes, what is actually the question is, what is partnership? Right, you can even write that definition, but only remove that section 4 and all, you can directly write. That is relationship between persons, same thing you can write here. Then write any one feature of the partners, that is sharing of profits and losses, agreement, there are so many, unlimited liability. Then state any one content of the partnership deed. You can write name of the partner, name and address of the partner, name of the firm, name and address of the firm, name and address of the partner, capital contributed, profit sharing ratio, there are so many, you can write any one. Mention any one method of maintaining partners capital account, there are two, you can write any one. One is fixed and another one is fluctuating. Next is, why is profit and loss appropriation account prepared? To show how the profits are being distributed among the partners. What is the rate of interest on advances? 6%, it is simple. When do you prepare partners current account in partnership? When the capitals are maintained under fixed capital method. Otherwise we don't. State any one feature of fluctuating capital method. Capital changes from year to year. Find out interest at 5% on a capital of 2,50,000 for 6 months. It will be 2,50,000 into 6% into 6 divided by 12, or you can do it 6 1s are 6 2s are 2 1 3, like this also you can do. Okay, it will be 6 divided by 100. Okay, and this will be 2,50,000. So 2020 gets cancelled. Okay, then 6 1s are 6 2s are 2 1s are 2 3s are. So I think it will be 7,500 rupees. Just check. It will be 2,50,000 into 6 by 100 into 6 by 12. Okay. Done. In the absence of partnership deed, the profit and loss of the firm is to be shared equal. Yes, it is true. In the absence, it will be equal only. Under fixed capital method, the partner's capital account will always show a debit. No, it will always show credit balance. Hence, it is false. Because under fixed capital, we will always have credit balance. When a fixed amount is withdrawn during the middle, yes, middle means it will be 6 months, right? So the statement is true. Profit and loss appropriation account is merely extension of profit and loss account. Yes, it is true. Then, interest on partners capital is debited to partners capital account. No, it is credited to partners capital accounts. Hence, it is false. Next. 2 marks question. For these two, you can write the same answer. Only if they ask define, you write section 4 of Indian Partnership Act 1932. Otherwise, you omit it. That is same. Section 4 of the Indian Partnership Act 1932. Partnership is a relationship between persons who have agreed to share the profits of the business carried on by all or any of them acting for all. Then, what is a partnership deed? See, you need to remember 3 things. It is a written agreement signed by all the partners. Okay. Then, stamped according to the Indian Stamp Act. Or even you can add one more sentence here, that is written agreement containing the terms and conditions of the partnership. Then, signed by all the partners and stamped according to the Indian Stamp Act. That is called as partnership deed. What is fixed capital method? 2 lines are very important. Under this method, the capital remains fixed. This should be the first sentence. And all the adjustments are made to a separate account called as current account. Then, what is fluctuating capital method? Same. Under this method, the capital changes from year to year. And all the adjustments are made to a separate account called as current account. Very simple to understand. Next, state any two differences between fixed and fluctuating. इसको यह बना सकते हैं. Under this, capital remains fixed. Under this, it changes. Here, adjustments are done to capital account, and here, adjustments are done to current account. So, these two are the differences between fixed and fluctuating. State any two हो गया यहाँ. Then, what is guarantee of profit to a partner? See, under this arrangement, one or more partners give an assurance to the incoming partner that he will be getting minimum amount by way of share of profit. What do you mean by past adjustments? These are this you need to remember. Omissions and commissions committed by the clerk or accountant in the past year. Then, name any two methods of calculation of interest on drawings. There are three methods: direct, product, average. You can write any. Average को और एक नाम क्या है? Shortcut. So you can write any one. That is direct, product, and next is average or shortcut. Then, what do the interest on drawings be generally provided to the partners when it is mentioned in the partnership deed? Remember, it should be there in the deed. If it is not there in the deed, then it will not be provided. Then, how do you close P&L appropriation account in the partnership? By transferring it to the capital accounts. Partners capital we call it as. By transferring it to the partners capital. Then, state any two special aspects of the partnership. It can be profit sharing ratio, it will be capital contribution, then goodwill. These all are the special aspects of partnership. Next, there are like 6 marks. We will be dealing with them later, and I have separate videos for them. Next, let's come to admission of partner. Now, when we come to the second chapter, that is admission of partner, first, multiple choice questions. At the time of admission of a new partner, general reserve appearing in the old balance sheet is transferred to only old partners. New partners are not entitled to these things. Then, A, B and C are partners. If D is admitted, the firm will be reconstituted because it will not be dissolved, nor partnership, old firm and partnership are dissolved. No. Then, old partnership is dissolved. It is somewhere close, but this will be the right, that is reconstitution. Next is, on the admission of a new partner, increase in the value of asset is credited to. When there is an increase in the value of asset, it will be profit. If it is profit, then revaluation account is credited. So this will be the answer. Then, at the time of admission of a partner, undistributed profits appeared in the balance sheet of the old firm is transferred to the capital accounts of, very simple, as we discussed earlier, old partners in old ratio. There will be new partners, new ratio का scope ही नहीं है. Then, A and B are partners with a capital of 45,000 each. C is admitted for 1/3 share. He brings 60,000 as his capital. What is the hidden goodwill? The answer is 1 lakh. The answer is 30,000. How it is 30,000? First, 60,000 into reverse of the share. कितना होगा ये? It will be 1,80,000 based on the capital of the new partner, and minus the existing total capital should be deducted. It will be 45 plus 45. That comes to 1,50,000. So the remaining 30,000 is considered as goodwill. Next. Which of the following is treated as reconstitution? All of the above, because in none of the cases the firm is dissolved. Okay. The profit, many of you have doubt over this change in PSR. Remember this change in PSR, right? It again amounts to reconstitution because we have to change the partnership date. Then profit and loss on revaluation is shared among the partners in very simple old profit sharing ratio. Then asset and liabilities, whatever happens before admission, it should be done in old ratio. Assets and liabilities are recorded in the balance sheet after admission of a partner in at revalued value, because you know that after preparation of revaluation account we deduct or add those adjustment amounts in the balance sheet. We call them as revalued figures. OPSR minus NPSR is equal to SR, that is sacrifice ratio. In the absence of agreement to the contrary, it is implied that the old partners will contribute to new partners' share of profit in their old ratio only. Remember, because of this, we write this sometime. OR is equal to SR, that is old ratio is equal to sacrifice ratio. Later I will come, you remember this so that we can discuss problems on this later. The balance of reserve and other accumulated profits at the time of admission of new partners are transferred to, again, old partners in old ratio. Remember, the balance of reserves and accumulated profits. So, old partners in old ratio. Revaluation account is debited. See, there are two reasons. Revaluation account is debited for loss. When there will be loss? When the asset decreases or liability increases. See, provision is a liability and the provision has increased. That means there is a loss. So, loss andre ide answer agtadri. Increase in the value of building, it is profit. It will be credited. Decrease in the creditor. Creditor is a liability. When the liability decreases, there is profit. Again, it is credited. So, transfer of loss, wo bhi credit side pe aata hai. So, the answer is 1. Increase in PBD. Now, A and B are partners sharing profits and losses in the ratio of 3:1. C is admitted into partnership for 1/4 share. What is their sacrificing ratio? It is again 3:1. Again I said, see what is OR? 3:1 is equal to SR, because they have not mentioned here how they have how much they have sacrificed. It means that when there is nothing, we assume that they have sacrificed in their old ratio. Then, on the admission of a new partner, increase in the value of asset is debited to. Increase in the value of asset. See, when the asset value increases, the asset account is debited. Hence, we need to debit asset, and revaluation account is credited, because when the value of asset increases, it leads to profit and profit should be credited. A and B are partners sharing profits in the ratio 3:1. They admit C for 1/4 share. Okay. Then question arises, what is their new profit sharing ratio? First you need to understand, here A, B, C are there. C share is 1/4. They have already fixed. Now let's see in which all options 1/4 is there. This is not there. Yes, 4 ones are, 4 fours are. So these all are 1/4. So out of this I need to understand. See, what if nothing is mentioned regarding sacrifice, because we don't know how much A has sacrificed and how much B has sacrificed. In that case, what we should do, we need to assume that old partner has sacrificed in the old ratio only. So that means your OR, your SR and your new ratio all will remain same. Okay, so first OR is 3:1. Now we need to check in which of these options old ratio of A and B is in the ratio 3:1. First, 9 and 8 not possible. 10:2 not possible. 4 and 8 will be 1:2, but not but it will not be 3:1. But here it is possible. 3 ones are 3 threes are. So hence the answer is A. Or you can do the working also, but it will take time. How you need to do it? First, 1 minus 1/4 you need to do. It will be 1 minus 1/4 will be 3/4. then this 3 by 4 should be multiplied with 3 by 4 and this 3 by 4 multiplied with 1 by 4, their old ratio. So this will become 9 by 16 and this will be 3 by 16 and 1 by 4 into 4 by 4, it will be 4 by 16. So that comes to 9:3:4. That is what we are seeing here. 9 by 16, 3 by 16 and 4 by 16. X and Y share profits in the ratio of 3:2. Z was admitted as new partner who gets 1/5 share. The new profit sharing ratio if Z acquires 3 by 20. Remember, if I make this as 3 by 20, the 3 by 5 को अगर मैं 20 में कन्वर्ट करूंगा तो बन जाएगा क्या 12 by 20. Out of that, how much X is sacrificing 3 by 20 and 2 by 5 into 4 by 4 करेंगे तो कितना आएगा 8 by 20. Out of that, how much he is sacrificing 1 by 20. So that comes to 9 by 20 and this will be 7 by 20 and this 3 plus 1, how much it will be 4 by 20. The answer will be 9:7:4. Very simple. Asha and Nisha are partners sharing profits in the ratio 2:1. Asha's son Ashish was admitted for 1/4 share, which 1/8 was gifted by Asha to her son. The remaining was contributed by Nisha. Goodwill of the firm is valued at 40,000. How much of the goodwill will be credited to the old partner's capital account? Now let's see how. 1 by 4's half is 1 by 8. That means in this 1 by 4, both are contributing 1 by 8 and 1 by 8. That we need to understand. Okay. So now the question is, how much is to be contributed? Very simple. The total goodwill of the firm is 40,000. And 40,000's 1 by 4 is how much? 10,000. And this 10,000 should be shared equally. That becomes 5,000 each. 1 by 8 and 1 by 8. Or you can directly multiply 40,000 into 1 by 8. Now, average profit of the firm is 15,000 and capital employed is 1 lakh. Capital employed means the net worth. Net worth of the business is 1 lakh and the normal rate of return is 10%. Then the value of goodwill under capitalization method. See, if I look at my earnings, that is 15,000, and if I look at the normal rate of return which industry is achieving, then I will come to know that my market value is 1,50,000. But now how much is my net worth? Net worth means assets minus liability, or जो भी मेरा capital employed होगा, that will net assets. Sorry, it's not net worth. It is net assets. So net assets is 1 lakh, but my market worth is 1,50,000 or market value is 1,50,000. So that means 50,000 is going to be my goodwill, or if we call it as capitalized value will be the right one. Okay. Next, fill in the blanks. Right. Old ratio is used to distribute accumulated. मैंने अभी बोला था कि पहले का जो कुछ भी डिस्ट्रीब्यूट करना हो, old ratio will be the base. Then profit or loss on revaluation is shared among the old partners in old ratio only. Old minus new is sacrifice ratio. Here it is old ratio. Okay. Then accumulated losses are transferred to the capital. Old ratio ne again. Okay. General reserve is to be transferred to partner's capital account at the time of admission. We know very well. We transfer capital, reserves, profit. Goodwill brought in by new partner in cash is to be distributed among the old partners in sacrifice ratio. If the amount brought by new partner is more than his capital, the excess is known as hidden goodwill. Account is debited for the increase in the value of asset. Very simple. asset account is debited for increase in the value of an asset. Then unrecorded asset is to be credited to revaluation because it is profit. Unrecorded asset is a surprise profit. Due to change in profit sharing ratio, some partners will gain in the future profits, but the others will lose. Goodwill is an intangible asset. Then dash account is credited for cash brought by new partner for his share of goodwill. Dash account is credited, na? It is new partner's capital account is credited. Dash ratio is required for sharing profits and losses and adjustment of capital. It is NPSR, that is new profit sharing ratio. Then sacrifice ratio, old minus new. Okay, goodwill is an intangible asset, or even you can make AS26 also. Right, here it is AS26, that is accounting for intangible assets. Then new share, right? New share is, I think, share in future profits. Okay, then or even this also be right, that is old minus share sacrificed. Then average profit method is used for valuation of goodwill. Right of new partner, adu share in future, it is also there. Then shortage of funds is the reason for admission. Okay, and then right of new partner is to share in the future profits and losses. Now, one more questions. What is partnership? This we have already discussed. What do you mean by reconstitution of partnership? That is change in the, very simple, it is the change in the partnership deed. Then, or even profit sharing ratio is also there. Then state any one reason for admission of new partner. Shortage of funds, right? Like lack of managerial efficiency. Then goodwill. State any one right acquired by a newly admitted partner, right to share profits. Why the NPSR is required at the time of admission of partner? To share the future profits and losses and to adjust the capitals. What is goodwill? An intangible asset or name and fame of the business which helps to earn extra profits. State any one factor affecting the value of goodwill. Place of the business, right? The nature of the business. What is normal profit? The profit which is achieved by the industry, right? Then state any one method of valuation of goodwill. Super profit, average profit. Give formula for sacrifice ratio, old ratio minus new ratio. Then which account is to be debited to record the increase in the value of an asset? Asset account is debited. What is revaluation account? It is an account which is prepared at the time of, here we can write admission of partner. It helps us to find out the profit or loss on revaluation of assets and liabilities. Which account will be credited when there is a loss on revaluation account? See, when there is a loss means debit balance, but we need to credit in order to transfer. So it will be partners capital, old partners capital account debit to revaluation account. So the question is, which account is to be debited? So it will be old partners capital account is to be debited to revaluation account. Then what is hidden goodwill? The definition, like the extra amount brought other than his share of capital is called as hidden goodwill. Then state true or false. First, goodwill brought in cash by new partner is distributed among the old partners in their sacrifice ratio. Yes, it is true. Goodwill brought in cash. Then next, in case of admission of a partner, profit or loss on revaluation is transferred to old partners capital. This is also true. It is transferred to only old partners. Then accumulated profit is transferred to all, no, it is not all partners, it is only old partners. The debit balance of profit and loss account is shown as an asset. No, debit balance is shown as liability or deduction from reserves. It is sorry, it is shown as the asset. It is true. Then balance sheet will be debited to old part. The debit balance of, let me read it completely. The debit balance of profit and loss account shown on the asset side of the balance sheet and debited to old partners. Yes, because profit will be credited and loss will be debited. Then increase in the value of asset is credited to revaluation account. True, because it leads to profit. Next, the traditional name of revaluation, yes, true, it is adjustment account. Goodwill is an intangible asset. True. Then decrease in the value of liability is debited to revaluation account. No, it is credited. Why? Because decrease in the liability is profit. Sacrifice ratio is required to distribute the cash brought by new partner among the old partners for his share. Yes, true, same it is there. Then share sacrificed is equal to old minus new. Yes. So in the next class, we will discuss other chapters. In today's class, we stop our discussion here only with the admission of partner, and in the next class, we will look at retirement and death. Okay, thank you very much. Madam.